Thank you for the introduction, Shireen. Good day, everyone. Today, I'm going to share two key messages about Asia-Pacific economic outlook. First, while a pickup in global growth momentum is vulnerable to geopolitical risks, Asia-Pacific will remain the biggest growth engine for the world. The second message is disinflation has become more uneven in recent months, leading the market to pare back expectations of the timing and the magnitude of rate cuts. So let's get started. The risk of regional war in the Middle East has increased, following an Iranian attack against Israel and a subsequent response from the Israeli military. Our base case remains that a full-scale regional conflict will be averted, in part due to diplomatic efforts to limit any retaliatory responses, aligning with the muted initial reaction of commodity and financial markets to the news. Still, uncertainty over the outlook has increased and is likely to persist. In an escalation scenario where the economic impacts would likely be felt through various transmission channels, including higher crude oil prices, a resumption of inflationary pressures, and related constraints on monetary policy easing. The adverse effects on growth prospects would be most acute in the advanced economies, which are typically net energy importers. Having said that, globally, a broader-based pickup in economic activity continues to be signaled by various purchasing managers' indices. Business activity in both manufacturing and service sector is improving, albeit modestly. Business activity growth in emerging economies also continues to outperform advanced economies. S&P Global Market Intelligence has upgraded our annual global real GDP forecast for 2024 from 2.6% to 2.7%. However, underneath the global numbers, there is substantial variation among different economies. For instance, U.S. economic performance has been exceeding market forecast, while in Asia-Pacific, growth is also uneven. India and Indonesia will likely lead the region as some of the fastest growing engines, while mainland China is facing multiple headwinds. Over the next decade, Asia-Pacific, which is the red color in the pie chart, will contribute 55% of the world's real GDP growth, in which more than half of the region's growth is from mainland China. And we have already taken into account the unsteady recovery we've seen since the pandemic reopening. Meanwhile, India and ASEAN are the region's rising growth engines. A gradual recovery in electronics exports, combined with a continued rebound in international tourism, will support the export sectors of many APAC economies. These will filter through wages and wealth and bolster household consumption. In mainland China, the better-than-expected recovery in the first quarter of 2024, driven by manufacturing strength and a rebound in service consumption, has laid a strong foundation for the economy to reach its 5% annual GDP growth forecast this year. Although sequential moderation is expected in the second quarter, given sustained demand weakness. Policy tools would include reserve requirement rate cuts, interest rate cut, as well as local government special purpose bond and tax reduction, among other things. The latest 1 trillion yuan sovereign bond issue, which is around 1% of China's nominal GDP, leads us to expect more proactive fiscal policy is on the horizon. This issue will likely boost economic growth in the next few years. Our first message focuses on how economies are growing at different speed while facing geopolitical risks. What does that tell us about the inflationary outlook, which is a key factor for central banks in deciding when and by how much they are going to cut policy rates? That brings us to the second key message today. Disinflation has become more uneven in recent months, leading the market to pare back expectations of the timing and the magnitude of rate cuts. Our forecast for global CPI in 2024 is 4.8%, down from 5.7% in 2023. A further moderation to 3.3% is forecast in 2025. CPI in APEC, excluding mainland China and Japan, is forecast to fall to 4% in 2024, from 5.4% in 2023. Core inflation is on a downward trend in most of the major economies in Asia Pacific. However, food prices remain volatile, posing a risk to a disinflation trajectory. Globally speaking, further declines in CPI rates are generally forecast as supply and demand continue to rebalance. But sticky services inflation rates are contributing to a slower pace of disinflation. It is mainly because service inflation is more labor cost driven, typically more sensitive to domestic economic conditions. On the other hand, core goods inflation, which is sensitive to global factors such as commodity price swings and supply side bottlenecks, has been coming down more quickly. Crude oil prices had not been significantly impacted by the latest development in the Middle East. The price of Dated Brent crude has remained relatively stable within its recent range, close to $90 per barrel, despite the heightened risk of wider regional escalation. Excess global supply is expected to continue to dampen prices, but an escalation of the conflict is a key upside risk. Our assumption of limited inflationary effects from shipping disruptions is supported by recent data that showed a general shortening of suppliers' delivery times. So, how will a less certain inflation outlook shape the monetary policy pivot? For the US Federal Reserve, for now, fewer than 50 basis points of cut are expected by the end of this year, which is compared to a peak of over 160 basis points expected during late 2023. Disappointing inflation data have increased the likelihood of easing only from the second half of the year. The shift in US rate expectations has continued to put upward pressure on Treasury yields, providing near-term support for the dollar. In Asia Pacific, while we still maintain that most central banks in the region will be either cutting rates or maintaining rates given the moderating trends in inflation, the depreciating local currencies are pressuring central banks to act and stem the decline. One recent example is Indonesia, where the central bank unexpectedly raised its benchmark 7-day reverse repo rate by 25 basis points to support a tumbling rupiah. Another example is Japan. As the Japanese yen continues depreciating against the dollar, the central bank is also under increasing pressure to raise the policy rate again earlier than planned. In conclusion, we are in a world where change is constant, disruptions are normal. I hope you will find the message today helpful. Thanks a lot for listening.